You've poured your life into your business, years, maybe decades. Every drop of sweat, every sleepless night, every family event you skipped, you built it, you lived it, and now you want to be rewarded for that sacrifice. But here's the harsh truth: a buyer doesn't see all that. They don't care about your hard work. When they look at your business, they don't see your story. They see a spreadsheet. Today, we're pulling back the curtain on what buyers really look for. It has almost nothing to do with your emotional investment and everything to do with cold, hard data that might just surprise you. Getting this right is the difference between a life-changing exit and a soul-crushing disappointment. The great disconnect: your sweat versus their spreadsheets. If you include universities and all other courses, some estimate that there are 1,200 business buying courses per year. That's not counting the already existing business buyers, just in the US alone. And there's a huge gap between how you see your business and how a buyer sees it. As the seller, you're emotionally attached. This is your baby. You're focused on the effort you've put in and everything you're about to lose: the identity, the routine, your creation. And there's even a psychological term for this: the endowment effect. We naturally overvalue things we own, but a buyer isn't paying for your memories or your emotional attachment. They're buying one thing and one thing only: the future. They're not buying your history. They're buying a predictable machine that generates future cash. They look at your business like any other investment, whether it's a stock or a piece of real estate. Every decision they make gets filtered through two simple questions: what's the return and what's the risk? One of the most painful mistakes sellers make is pricing their business based on what they feel it's worth, or worse, based on a number they heard from a buddy at a barbecue. This almost always leads to an unrealistic price that scares off serious buyers before you even get to talk. Your valuation isn't a medal for your sacrifice. To a buyer, it's a math problem, and if the numbers don't work, the deal won't either. Understanding the buyer's language, speaking in EBITDA and multiples. So if they don't care about your sweat equity, what do they care about? Profit. But they speak a very specific language, and the two most important words you need to learn are SDE and EBITDA. For most small businesses, the magic number is SDE, or seller's discretionary earnings. Just think of SDE as the total paycheck a new owner-operator would get from running the business. You find it by taking your net profit and adding back your own salary, any personal perks you run through the company, and any one-off expenses. It shows the real earning power for a new owner. For larger businesses, buyers talk about EBITDA. That's earnings before interest, taxes, depreciation, and amortization. It's just a standardized way to measure a company's core profitability. Stripping away all the creative accounting and financing stuff, it lets a buyer compare your business to another one, apples to apples. Once they have that number, your SDE or EBITDA, they apply a multiple to it. The multiple is just a score that reflects how attractive and low risk the business is. So if your business has an EBITDA of 500,000 and the buyer thinks it's worth a 4x multiple, the valuation is 2 million. It's that simple and that brutal. What that means is every dollar of profit you make could be worth $3, $4, or even $5 at the exit. But that multiple isn't pulled out of thin air. It's decided by a few critical factors that you absolutely need to master. The 4 pillars of a buyer-proof valuation. Buyers are really just trying to answer 4 big questions. These are the pillars holding up your valuation. If any of these are shaky, your multiple and your price will come tumbling down. Pillar 1, predictable and verifiable profitability. It's not enough to be profitable. Your profits have to be predictable and, most importantly, provable. Buyers will put your financial records under a microscope, and they're looking for one thing: consistency. Wild swings in revenue are a huge red flag because they signal risk. They also want clean, organized financial statements, ideally blessed by a CPA. If your books are a disaster or your profit came from one lucky project that won't happen again, a buyer sees that as a gamble. They have to trust the numbers. If they can't easily verify your profit, they'll either walk away or slash their offer to cover their risk. Pillar 2, reduced risk and owner independence. Right after profit, a buyer is paying for peace of mind. The less risky your business is, the higher the multiple they'll pay. And what's one of the biggest risks? You. If all the customer relationships, all the key processes, and all the strategy live inside your head, then you don't have a business. You have a job. A buyer has to ask, if the owner gets hit by a bus, does the business die? If the answer is yes, the value plummets. You have to build a business that can thrive without you. That means having a strong management team, documented systems, and a diverse customer base. Being dependent on one or two big clients is another massive red flag. Buyers know that losing one of those clients could cripple the company. The more spread out your revenue is, the safer the investment, and the more valuable your business becomes. Pillar number 3, a clear path to scalable growth. Buyers aren't just buying where you are today, they're buying where the business can go tomorrow. They need to see a real, believable opportunity for growth. What's the plan after you're gone? Can the business expand into new markets? Are there new products ready to launch? This can't just be a dream on a PowerPoint slide. You need a realistic growth strategy. It could be done based on industry trends, a clear expansion plan, or proven demand for a new service you haven't fully tapped into yet. A business with a clear runway for growth is exciting. You have to show them exactly how they can come in and make even more money. Pillar number 4, grounding in market reality. Finally, your business doesn't exist in a bubble. Its value is tied to what's happening in the real world, the economy, the interest rates, and what's hot in your industry. Buyers always do a sanity check by looking at what similar businesses have recently sold for. So many sellers have a widely inflated idea of what their business is worth because they aren't looking at the actual data. You need to know the typical multiples for a business of your size and your industry. A software company might get a 7x multiple, while a local service business might only get 2x or 3x. Going into a sale ignorant of these benchmarks is setting yourself up for failure. An accurate valuation is a snapshot in time, and you have to be realistic about what the market is willing to pay right now. Now that you know how a buyer judges a business, how does yours stack up against those 4 pillars? Number 4, the psychology of the deal. Beyond the numbers, you have to get inside the buyer's head. There are a few psychological triggers that are always in play during a deal. First, there's loss aversion. Buyers are terrified of looking stupid and making a bad investment. Every single risk you can remove, messy books, a key employee who might leave, that one huge client, calms this fear and makes them more comfortable paying your price. Your job is to de-risk everything. Second, there's scarcity. When buyers feel like they might lose out on a great opportunity, it creates urgency. This doesn't mean you should invent a fake bidding war, but if you position your business as a high quality, well run asset, it naturally shifts the power dynamic in your favor. And finally, remember the peak end rule. People don't remember the whole experience, they remember the most intense moments and how it ended. If your due diligence process is professional, transparent, and organized, it builds incredible confidence and leaves a lasting positive impression. It makes them feel good about the price they're paying. A messy, chaotic process does the exact opposite. It kills trust and makes them question everything. In conclusion, you've invested your life in this business and you absolutely deserve to be rewarded for that. But that reward isn't given out for past effort. It's earned by building something a buyer sees as a valuable, reliable asset for their future. So forget what you've put into the business. That's history. The real question is, what will a buyer get out of it in the future? Is your profitability clean and provable? Is the business ready to run without you? Is there a clear path for it to grow? And is your price grounded in reality? When you finally make that mental shift from your story to their investment, you stop just having a valuable business on paper. You start having a sellable one in the real world. If you're a business owner wanting to get more information about what it might look like to sell your business or get a free valuation, just click on the link in the description below and schedule a meeting with me. And of course, make sure to subscribe, and we'll see you in the next video.